CNBC TV 18.
Hello and welcome to the CNBC TV 18 Investment Guide. I'm Surabhi Upadhyay. Now, this metals rally has dazzled people around the world and here in India. We've seen stock prices soar, and a lot of people have this left out feeling with the confusion and the critical question, am I too late or can I still enter now? Well, we're going to hope to answer a lot of these questions, and we have two experts on the show to do just that, to give us the international perspective on pricing and demand and how sustainable all of this is. We have Keith Tan joining in, who's the Senior Pricing Manager, S&P Global Platts, and he's joining us all the way from Shanghai. And we, of course, have Amit Dixit of Edelweiss Institutional Equities right here to tell us what to do with metal stocks and whether it's the right time to get in or the right time to book profits. Thank you, gentlemen, very much for joining in and being here to give us all the perspective. Let's kick things off by handing it over to Manisha first, and she'll tell us exactly how the whole ferrous move has played out over the last few months.
If there is a super cycle in commodities, then it perhaps is being led by ferrous metals, where we have seen all-time highs in steel and iron ore prices. When you look at this year itself, we have seen more than 36% of gains in steel and a good 44% of gains in iron ore. We are looking at lower supplies of iron ore and very strong demand for steel, and that has been supportive. Well, that's the global picture in last year, where we saw a contraction in steel demand by 0.2%. But this year, 5.8% of a global consumption is what the markets are working with, and the next year as well is expected to be looking at positive growth. When you look at the Indian numbers, they are even better. Last year was a decline of 13.7%, but this time around 19.8% of a gain in demand is what we are working with. Strong margins, lower production and strong demand are supportive factors here.
Okay, thank you very much, Manisha, for that quick wrap up. And let's kick it off now. Keith, I'm going to come to you with the first very, very basic question. Whatever has led to all of this, I mean, especially on the ferrous side, do you see this as sustainable? Is this indeed a super cycle, or is this just easy liquidity that's found its way into the metals market?
Yeah. Good afternoon, Surabhi, and thanks for having me here today. I would say definitely government stimulus has had a role to play in this, but just more than that, the question of the timing of the recovery of the various major economies from the pandemic has also been very key. So while we see China having been one of the earliest to recover from the pandemic, this drove strong domestic demand, which we see lasting to today. This was given a second boost. The strong demand that we've seen received a second wind, so to speak, in the form of recoveries and government stimulus in other regions like Europe and the US. So while we saw capacity utilization for steel and other industrial metals having recovered in the US and in the EU, for example, they have still quite a lot of barriers placed on imports. And this has meant that domestic producers of end-use products like anything from autos to machinery, they've had to contend with higher domestic steel prices. So they are operating essentially in protected markets. So to such an extent that hot rolled coil steel prices, for example, they've exceeded $1,000 much earlier in such places than in places like China and India, for example. So, and they remain still higher today. So this is what's leading to the cycle that we are seeing now.
Okay, fair enough. Amit, let's bring you into the conversation as well. What do you think on the steel side? And it's interesting, let's pull up the price charts as well. They'll tell us what's happening because the price rise in India is actually lower. I mean, what we're seeing in the international markets, that's eclipsing the price rise that we've had here. So, Amit, your view on the sustainability of all this?
Yeah, hi, Surabhi. Thanks for having me on the show. So, the basic thing, as you rightly mentioned, that Indian prices still are cheaper compared to the rest of the world. And I would like to highlight the fact that the shortage of steel still persists very much. So, if you look at the lead times in Europe, they are well into Q4 of this year. While even in other countries, I mean, the lead times have stretched. So on one hand, you have got shortage of steel. On the other hand, you have Indian prices, Indian domestic prices, that is, at a discount to landed price of imports and at a discount to the export prices as well. And therefore, there is little bit of more headroom for Indian prices to go up because the threat of imports is simply not there. And Indian steel producers are earning better margins when they ship abroad. And coupled with the fact that despite little bit of weakness in demand in domestic market because of resurgence of COVID-19, we have seen people exporting and therefore the inventory is not building up in the market. So as and when Indian demand will pick up, you will find that the restocking will start and therefore the prices will hold on for longer. And from the indications that we have, look at it, that ArcelorMittal has increased prices almost 15 times this year. That shows you the strength in demand. And yesterday itself, we saw export prices getting a further leg up of almost 6.7% week on week across the regions. So Asian prices, FOB basis, are now above USD 1,000 for the first time ever. So that shows you the strength in demand. And of course, the price intensity, which I believe is going to persist for another quarter or so.
Okay, so you're keeping a bullish view on these prices sustaining, perhaps even increasing here in India. Keith, tell us a little about the Indian companies that you might track. Is there a case to believe that their profitability and their balance sheets can improve considerably if these prices last? What's your sense on some of the players over here?
Right. Well, we mainly track Indian steel companies in terms of the sale prices that they achieve from selling steel, obviously, and of course from the input costs that they are subjected to. So their iron ore costs, their coking coal costs, for example. So I would say in recent months, Indian steel companies have benefited, in fact, from having been able to export a lot of steel to places like the EU, where the quota has been reached, in fact, to Turkey and to the Middle East, where, as Amit has mentioned earlier, prices are much higher than in the domestic market. And this is causing, whether intentionally or not, tightness in supply in the domestic market, right? So, prices have exceeded $1,000 in these markets, and they are just approaching that level in the domestic market. But they are already at historical highs in Mumbai itself. So at the same time, you can say that the Indian mills have indeed been enjoying additional supply options of the raw material coking coal, especially from Australia, given that it's been given up by buyers in China in recent months. So they would have been enjoying strong margins. But as we speak, I think a few major mills like JSW, for example, are scheduled to perform maintenance. So there's been a lot said about what's taking place and trying to interpret what's going on, why mills might be taking such actions. But to my understanding, some of these maintenance actually has been due and perhaps even overdue from the previous quarters when steel prices were actually very high, and they had actually delayed these maintenance shutdowns to what we see to a period now when we see that demand is being a bit more subdued due to the resurgence of the virus. But by and large, I believe the mill's output continues to be very strong, and that's really something that quells some of the queries or doubts, in fact, of some of the buyers of Indian steel from overseas, and because they've been concerned about whether the mills in India would be able to continue to supply them, given that they have the obligation to supply oxygen for medical use, right? So, to my knowledge, this has not really been impacted by a lot in terms of the production output. So their margins will still be able to achieve margins, although sales volumes might come down.
Okay, because of the maintenance shutdowns. Keith, just a very quick follow-up. For a company like Tata Steel, getting the European operations on track is a big thing. And they showed some promise in the quarter that just closed. What's your sense on the European steel market overall? And can we expect the Tatas, for instance, to turn the corner there?
Right. I would say in the European market, they do have quotas in place. And in fact, Indian mills have been a key segment of the suppliers, supplying markets, suppliers, in fact, that have been selling and providing the steel to Europe, to the European end users. But as you may be aware, the EU does have import quotas in terms of the volumes that it may import from the various countries, and India has already reached it, right? So there has been talk about potentially Indian mills using up the quota, potentially using the quota that was left unused by the other origins. But I don't think there's been anything affirmative. There's been no agreement yet coming from the EU authorities. So, they will probably, the end users in Europe probably will have to face a period of, tight supply, domestic supply, as well as high prices. Whether this might or might not benefit Tata Steel Europe's operations, I guess, if you looked at the situation I outlined above, they might be a beneficiary in terms of being based in Europe and not having too much competition from imports. But that might also be scuppered because of the rising iron ore price now as we speak.
Okay. Got that. All right. Now, Amit, let's come to the very important question from a market investor point of view. And I just want to pull up a valuation table here, which just puts the numbers out there. And that's putting the rally in perspective, because if you're looking at these multiples now, Tata Steel is trading at almost 7.7, 7.8 times. That's higher than the 5-year or the 10-year averages. JSW Steel is at 8.6 times. The 10-year multiple was at 5.4. JSPL is somewhat in the range of the 5-year, 10-year, so not too much move over there. SAIL again is trading higher than at least the 10-year multiples. So how much does it leave on the table, Amit, and what are the stocks that you would back?
Yeah, so valuations are quite contextual, I would say. In India, if you look at the consensus estimates, I don't think they have been revised upwards, trending to the current level of prices. Now, for instance, if you look at Tata Steel's own valuation, so you're right, it was 7.7 before the results were announced. But as consensus has moved up, you will find that these valuations have also come off. So currently, as per the consensus valuation, it is trading at around 5.8 times. Similarly, for other stocks. So the consensus has not yet revised its earnings, and therefore valuations look optically very high. Now, if you compare the ROEs, by the way, of Indian steel stocks, so you will find that ROEs of all the Indian steel stocks are higher than their last 5 years or 10 years average. So therefore, higher ROE begets higher multiples. And even if you look at the global steel peers, their estimates have been revised upwards. So despite those revised estimates, we find that ROEs of Tata Steel, for instance, for JSW, JSPL, or even SAIL are higher. So when consensus will revise estimates upwards, you will find that ROEs will become even higher and valuations essentially will trend lower. So that will provide an attractiveness. Our top picks, if you look at it, we are kind of going ahead with the iron ore integrated plays because this rally is partially fueled by iron ore prices, which are the highest since on record. So therefore, our pick is Tata Steel with a target price of 3,300 rupees and SAIL with a target price of 150. So these are our top picks in the space.
Okay, got that. All right, we have to take a break, gentlemen, and then we'll come back and discuss the non-ferrous side of things. But as we take the break, here are two very interesting views. The first one is coming in from the top boss of Tata Steel, Mr. Kaushik Chatterjee, who knows a thing or two about this sector, and he's quite optimistic on the prices. The second one is coming in from Neelkant Mishra of Credit Suisse, who's saying he'd now move positions from ferrous to non-ferrous. Back in a moment.
As far as the steel prices are concerned, it's been much higher internationally than in India. International prices are around, say, 10-15% higher than the Indian prices. The price is the highest in the US, followed by Europe, and then Asia prices.
The way to consider the metal space is perhaps start to move from steel to the non-ferrous side. Because the $190 iron ore, there were companies in steel, if you remember the last cycle, 2003, there were companies that were bankrupt. and they ended up with 20,000 crores of net cash within 4 years. Right? Because in India, many companies are self-sufficient on iron ore. So a lot of the exceptional profits that you are seeing from some of the steel companies in India is actually because of ownership of iron ore or having iron ore in close proximity, which gives you a significant cost advantage. So it's important that iron ore stays at 190.
Welcome back to the CNBC TV 18 Investment Guide, and we are discussing metals. It's time to talk non-ferrous. Big rally there. Manisha is putting it in perspective for us.
It has been a neck-breaking rally for all of these metal prices, where we have seen multi-year highs, record highs for some of them. It has been an all-time highs for copper, 11-year highs for aluminum, and 2-year highs for nickel is how we are trading. With the strong demand recovery in the countries where they are recovering from COVID, and then the EV and the green energy focus also seems to be improving the demand for many of these metal prices. The macro setup has been strong as well. The Fed support for ultra-low interest rates, and then constrained global logistic markets, where we are looking at shortage of tankers and containers, and higher freight prices also seems to be finding its way in for metal prices. China clearly is the biggest factor here, because more than 50% of consumption comes in from China. They have been buying strongly, and then the Chinese carbon emission targets have led to cut in output. That seems to be finding its way in prices.
All right, let's take this forward with our experts on the show. Keith, so now when we're talking aluminum, copper, zinc, a lot of these base metals, which one are you most optimistic on in terms of a favorable demand scenario? I mean, there could be some disruptions in supply, but they could last only for a short time. But where is the strongest fundamental pull?
Right. Well, this is by no means a recommendation, but I wanted to talk a bit more about copper, because amongst the metals in the base metals complex, I think that you can say pretty much the same story of all of them. They have been, essentially whipped up by the concerted recovery that we've seen in the various economies that we've mentioned earlier. But what's especially tagging or plaguing copper, if you want to put it that way, is the focus on, in fact, the environment and inflation, which kind of Manisha has alluded to earlier. So there's now a situation where governments are trying to tackle some dual challenges, which perhaps one might put compare and say that they might be at odds. So there's the environment to look at, and then of course now the buzzword is inflation, which necessarily gives rise to some dilemma. So to cut carbon emissions, we've called for production cuts in polluting and energy consuming industries, of which many metals fall under, and that's not really something that's going to be helping ease the price in this kind of high price environment that we are under. So any supply cuts threaten to push these prices even higher. But on the other side of things, the focus on environment has also meant the increase in copper demand. So already infrastructure and property stimulus are already key consumers of copper, but then the push towards carbon neutrality also means that it being this indispensable in electric vehicles, windmills, that's really whipping up demand for copper. And on the supply side, there has also been disruptions taking place. So mine strikes in Latin America, and the COVID situation as well in Chile and Peru. That's really what's causing a reduction in supply of copper concentrates, which is the raw material of copper. So it's essentially a confluence of factors coming in together at the same time.
Sure, got that. Okay, Amit, over to you. The thing is that, we only have companies like Hindalco which operate on, the treatment and refining charges. So they're not really big miners per se of that metal, though they're very big on aluminum. So which metal would you play? And then more importantly, which stock? How do you play it?
Yeah, sure. So in case of, in Indian perspective, I would say that in copper, you have got only one pure play, that is Assam Copper. Otherwise, both Hindalco and Vedanta, they have TCRC stuff. And in case of Vedanta, particularly because Tuticorin smelter is not operational at the moment, so only Hindalco is left. But that operates on a fixed TCRC margin, so not much gains over there. Having said that, I would place actually aluminium a bit more over zinc because of the fact that on one side you have got the demand side globally booming, particularly in case of auto and in the thrust for EVs. And then on supply side, you always have this iota of doubt from China because they have gone hammer and tongs after steel because of carbon emission. So aluminium being much more carbon intensive than steel can attract their attention any day. So therefore, I would like to put my money on aluminium, and therefore Hindalco is our natural bet, and in fact our pick in the non-ferrous space. And also add to it that in case of Hindalco, the Novelis business was never under threat because it is a spreads business and gains from volumes. Particularly, packaging is doing well for them, and automotive is doing equally well. Now, in case of primary aluminium business, since aluminium prices, the spot prices have gone up, so primary aluminium will also join the party. So clearly, we place our bet relatively on Hindalco.
So Hindalco gets the top billing for Amit. By the way, while we were discussing ferrous, NMDC is also a key pick at Edelweiss. But just to come down to final thoughts, Keith, what is the advice that you would like to leave viewers with? What lessons does history teach us? Whether this is a super cycle or not, but what are the red flags one needs to watch out for? Because when the commodity cycle turns, it can get very brutal as well.
So I've kind of been looking at these markets for more than 10 years now, and I think what's key is that markets are essentially cyclical, and where it comes to certain countries, we've typically also seen government intervention come into play, especially when prices are being seen as being overly exuberant. There are hints of this potentially happening in China already. So while the Ministry of Finance has in any case already announced the removal of rebates for exports of steel that took effect just at the start of this month. And that's really in an attempt to try to reserve steel for the domestic market, and at the same time lowered the import duties for various raw materials. So that's had a limited impact so far in terms of trying to tame prices. But the key difference between this cycle and I think what many people have compared what we are seeing today with the previous so-called, to use the phrase that you've used earlier, like super cycle, back before in the GFC days, is that the stimulus that we saw channeled back then and now are flowing essentially into different places. So previously, I think a lot of it went into capacity expansions, especially for steel and the other various industrial metals. And, in part that led to an overcapacity situation. But now there's a lot more caution, a lot more care made to make sure that, this stimulus does not again cause or flow into the expansions of these industrial metals. So
inflation.
So this is what's happening. Yeah. So what's happening essentially is without a concomitant increase in capacity, the demand is actually being whipped up in the end use sector. So this is leading to a pickup in price.
Sure. Okay, so we'll have to watch out for policy interventions. They can really change the cycle on a dime. That's definitely point taken. Amit, quick last word with you. We just have 30 seconds left. If there's, one money-making idea in the metal space that you would still back, ferrous, non-ferrous, related plays, what would it be? And any final word of advice you'd like to leave us with?
No, so we are more bullish on ferrous. So I would still say that Tata Steel looks the best place, just because of the fact that the recovery of European operations is not fully appreciated by the street. The second one being SAIL, of course, again, iron ore integration. And the third one, if I am able to put, is NMDC. The fact that, iron ore prices have risen and NMDC's prices are still at a discount to Orissa-based miners. And the fact that commissioning stroke divestment of steel plant can always have that extra bit of money. So I would go ahead with these three stocks in the same order.
Okay. Well, gentlemen, thank you very much for joining in and explaining the whole metals rally to us and also helping us figure out where money can perhaps still be made. Appreciate your time. That's it on this week's episode of Investment Guide. Thanks very much for watching. We'll see you again next week.